Joining us now is Fast Money friend and longtime Tesla bull, Gene Munster, managing partner of Deepwater Asset Management. Gene, I have to warn you, we've got some bears specifically on Tesla on this desk tonight, so I hope you don't feel outnumbered by us bringing you into the fold here. But Leah, what are we expecting for the quarter, and how is Tesla going to justify where it's at right now stock-wise?
So there's the near term, which is tomorrow, and then there's the long term. And as far as the near term, I don't know if the stock is going to be up or down after they report their earnings. The key topic, obviously, for earnings is going to be auto gross margins ex credits. In the March quarter, the street was looking for 20%. They missed it. They hit 19%. The street's looking for 18% this quarter. I suspect it's going to be light, somewhere between 17 and 18%. I don't think that's going to be an issue for the stock ultimately, because I think the commentary from the CFO is going to be to expect improving gross margins throughout the back half of the year. And so I just kind of put that as the starting point. I think all systems go when it comes to improving margins, despite what probably is going to be a miss for June. The outlook is positive. But I would love for the conversation, the debate, to be focused on the long term, because I think that's what's more important, Melissa. And ultimately, I think the long term, if we're going to boil the question down, it's not about auto gross margins ex credits. The long term question is this: can Tesla get to 10 or 20% market share of where eventually EVs will be 100%? And I will make the case that if their goal is for 20% share, if they do 10% share in a decade, so it's a long time, but 10% in a decade, that's a $1.1 trillion business. They are going to do $130 billion in revenue this year. If you're of the camp that traditional auto is going to catch up to Tesla, then I'd love to have a debate around that topic.
Hey, Gene, it's Dan. And again, I think you're a great long-term thinker. I'm not, especially. I've been a bad short-term thinker on this one of late. But it's interesting when you think about the short-term right here. Into last quarter, the stock had sold off 16%. They missed on gross margins. The stock sold off the next day 10%. It has since rallied since bottoming out post-earnings 100%. It's gained $450 billion in market capitalization since it was at 150 in the days after earnings. So when you think about the fact that they're likely to come in at 17% gross margin, who knows, whatever they say on the call, whether that's true or not, whether they're bottoming out or not, there is a price war going on right now. And so to me, in the history of tech, and you and I have talked about this a lot over the last 25 years, when you have declining margins like this in a market like this where there's just aggressive pricing, the more units they sell, it's worse for the margin here. So I'm just curious, how do you square the near term right now with your very positive long-term vision? Because the fundamentals don't seem to be improving quarter over quarter.
So I would square it up by saying I think margins are going to improve in the back half of the year. And if I'm wrong by a quarter, it's going to likely improve in 2024. And the reason is that they are ramping production at Austin, their 4680 battery, which has been a drag on margins. They've talked about lithium prices going down. That benefits Tesla more than it benefits Ford and Giga Berlin. And so that's my base case. Agree that facts are the facts. Margins have been down, but I think that they will rally back here, back half of this year into next year. And as far as the margins and the impact, I think this is a critical topic, which is traditional auto is getting smoked right now when it comes to EVs. Ford, they break it out, they lose 40% in their EV division. Polestar, half owned by Volvo, 45%. Tesla makes about 15% operating margin. My case is this: what you just described, Dan, that's going to be the world of traditional auto. I think they're going to continue to have struggles to improve those margins, because it's not just about ramping production. They have to redo their factories, rework their labor contracts, redo their software stack, change their distribution network. They have to start to adopt a more nimble, profitable playbook. And so I agree, margins go down, bad for the business. My bet is a year, 2, 5 years from now, we're going to be talking about big traditional auto that is going to be a fraction of the size that they are today. Just look at what's happening with Toyota today. I think it is a tale of what's to come.